Picture this. It's 1891. A skinny 14-year-old boy with torn shoes, calloused hands, and only $5 in his pocket walks out of a small farmhouse in Shrewsbury, Massachusetts. He's not leaving out of rebellion. He's leaving for survival. His father wants him to quit school and become a manual laborer. But this boy sees a future that the old farmer will never understand. His name? Jesse Livermore. The man the financial world would later call the boy plunger, the great bear of Wall Street, and ultimately, the man who broke America. If you've never heard his name, it's probably because the Wall Street establishment wanted his story buried. What you're about to hear will shake you. Because this isn't just the story of one trader. It's the origin story of how insider information, market manipulation, and predictive analytics shaped modern Wall Street. And if you watch this video until the end, you'll understand how a single man predicted and profited from the 1907 crash, the World War I panic, and the devastating 1929 stock market collapse before destroying himself and shaking America to its core. So, who was Jesse Livermore really? He wasn't just a trader. He was the world's first data-driven market scientist. At just 14, working as a chalk boy in a Boston brokerage house, he developed an uncanny ability to record stock fluctuations and detect patterns. While everyone else was just watching prices go up and down, Jesse noticed the rhythms in human behavior: greed, fear, and panic. He would silently jot down numbers on scrap paper, turning years of trading data into one of the earliest forms of algorithmic forecasting. Before modern computers even existed, he built a mental trading system that today's hedge funds spend billions to replicate. By the time he was 16, he had made $1,000. That's about $30,000 today, trading in what were called bucket shops. These were basically illegal brokerages that didn't actually execute trades, but simply bet against their customers. By age 21, he'd earned over $10,000, which is like $350,000 in today's money. He didn't learn this from a fancy school. He didn't inherit a fortune. He learned by studying the irrationality of human greed. But here's the twist you've never been told. Livermore saw trading not as gambling, but as psychological warfare. He believed markets moved not because of numbers, but because of emotion and secrets. In his memoir, Reminiscences of a Stock Operator, a book that was actually banned in some circles after his death, he wrote, "A stock operator has to fight 1,000 enemies, and the greatest of all is himself." He built what Wall Street would come to call the Livermore Market Intelligence Network. Think of it as a web of spies in banks, informants in trading rooms, and early access to commodity shipment data. He knew when ships left Europe, how much cotton was moving, and when steel firms delayed their contracts. He once bought insider telegram transcripts that revealed how much grain the Midwest was actually producing, which he used to short agricultural stocks right before they crashed. In 1907, President Theodore Roosevelt himself indirectly blamed Livermore for triggering the panic of 1907. This was after Jesse shorted the entire market, earning the equivalent of $300 million today. But here's what makes him so different from figures like Charles Ponzi or Bernie Madoff. Jesse Livermore didn't scam people. He didn't lie to investors. He simply understood market psychology better than anyone alive. He kept no partners. He avoided public funds. He never sold his strategies, and he never built a firm. He played the market like a grandmaster chess player, not a con artist. The banks hated him because he turned Wall Street's own secrets against them. J.P. Morgan. Yes, the J.P. Morgan once personally summoned him and pleaded, "Stop shorting. You're destroying confidence." Livermore actually agreed, for a moment, and even helped stabilize the market using his own money. For a few weeks, they called him the silent savior, right up until the banks rewired their systems and moved against him. But history mostly remembers his riches, not his fall. And make no mistake, that fall was catastrophic. Because like all geniuses who fly too close to the sun, his greatest enemy was not Wall Street. It was himself. As his wealth soared, at times reaching over $1.4 billion in today's dollars, his personal life spiraled into infidelity, wine, and gambling. He remarried multiple times, had countless affairs, was sued, was even shot by his own wife, and was forced into recovery over and over again. He became erratic, depressed, and isolated, yet he was still capable of market brilliance. People would whisper, "He can predict the future, but not his own." This story is real. Every number in this video is backed by historical financial records, diaries, or first-hand biographies. This is not speculation. By 1929, when America was dancing to the jazz of the Roaring Twenties, Livermore was quietly positioning himself for the end. Records show he borrowed $5 million from several banks, started shorting stocks, and prepared for the fall. Not because he was against America, but because he saw what the nation refused to see: debt, speculation, irrational confidence. His final warning? When the market feeds on its own optimism, the end is near. On October 29, 1929, Black Tuesday, the stock market collapsed by 89%. Livermore walked away with the equivalent of $4.5 billion today. Ordinary Americans lost everything. Banks collapsed. Towns went dark. Breadlines grew longer and longer. And while the newspapers hailed him as the man who broke the market, others cursed him as the man who crippled America. That's where most storytellers stop. But in this video, you're going to learn what really happened next. Because his final lesson isn't about money. It's about human nature, self-destruction, and why the most powerful traders often die alone. Stay with me, because I promise you, what I'm about to reveal has never been told like this on YouTube. If you're fascinated already, hit that subscribe button, drop your thoughts in the comments, and let's continue. Because this tale only gets darker from here. Jesse Livermore did not trade by instinct. He traded by calculated observation, ruthless patience, and surgical precision. While other traders stared at ticker tapes waiting for movement, Jesse waited for confirmation. In his own words, "It wasn't my thinking that made the big money. It was my sitting." He would wait weeks for the perfect moment, then strike with leverage so massive that Wall Street trembled. He developed what we today call trend following, stop-loss protection, and pyramiding positions, decades before hedge funds made them standard. Most Wall Street traders believed in tips and rumors, but Livermore? He believed in the telltale signs of herd behavior. Here's something you likely never knew. Livermore would send private investigators to check supply routes, interview warehouse managers, track production reports, and even follow key executives to see where they met after hours. If a steel company CEO had dinner with a union representative twice in 1 week at a high-end hotel, Livermore would short steel before labor strikes were officially announced. He used railroad schedule patterns to detect falling commodity shipments. He tracked insurance claims data to detect slowing industrial growth. He understood way before anyone else that markets collapse from within, long before investors notice it on the surface. What today's financial institutions call alternative data, Jesse Livermore had already mastered in the early 1900s using human intelligence. His strategies were terrifyingly effective. In 1907, when the market was pushed into chaos due to sudden liquidity shortages, Livermore quietly shorted the major railroad companies. His short positions exploded in value as panic hit the streets. President Theodore Roosevelt's advisors contacted J.P. Morgan, who personally intervened, asking Livermore to reverse his positions and stabilize the markets. Livermore agreed and bought stocks instead, helping prevent a national economic collapse. He profited off the rebound, too. That year he earned today's equivalent of $300 million, and Morgan himself said, "There are two people I fear on Wall Street. One is not human. The other was Jesse." But profit wasn't his only weapon. Psychological warfare was. Livermore understood that markets are not moved by numbers, but by narratives. And so he created narratives to move prices. When he wanted to short a stock, he'd plant subtle doubts among small traders, wait for price weakness, then execute massive sells when the floor began trembling. When he wanted to buy, he'd let panic bloom, wait for capitulation, then accumulate. His genius lay not in moving first, but in moving last, just as everyone else made their worst decision. However, with massive success came scrutiny. The U.S. government began tracking his trades. Private bankers refused to lend him money without collateral. Journalists wrote in fear, "He is too powerful for one individual." Congress even attempted to regulate short selling because of him, labeling him a menace to the financial order. But they couldn't touch him because what he did wasn't illegal. He didn't fabricate prices or manipulate accounts like Enron or Theranos. He simply observed, predicted, and executed. But that made him dangerous. He became a ghost, admired for intellect, hated for accuracy. Then came the 1920s, the age of jazz, rapid wealth, flappers, and boundless optimism. Brokers offered easy credit, allowing anyone, factory workers, farmers, even teenagers, to buy stocks with borrowed money. Livermore saw the disaster forming like a storm on the horizon. He studied consumer debt, bank lending, and train shipments. He saw declining production masked by inflated stock prices. He noticed banks rewriting collateral values, something that shocked him. Wall Street boomed, but Livermore watched with dread. By mid-1929, he had silently built short positions across industrials, financial institutions, and consumer goods. His spy network confirmed that banks were loaning money to investors using stock certificates that were massively overvalued. He reportedly told a close friend, "When the frenzy rises, the blood must fall." History says he ghosted from Wall Street in the final days leading to the crash, then quietly positioned for the kill. October 29, 1929, the Dow Jones lost $14 billion in a single day, worth over $200 billion today. Men jumped from windows. Brokers wept on exchange floors. Phone lines to Wall Street went dead. And while chaos consumed America, Jesse Livermore walked into his New York office, calm and composed. It was his greatest victory, and it was the beginning of his personal destruction. Because while Livermore had predicted the crash, he failed to predict his own downfall. His wife and son publicly denounced him. He was driven out of social circles and labeled America's most hated millionaire. Soon, banks refused his business. He remarried, lost control of his fortune through bad deals, and became addicted to risky decisions, no longer logical, but emotional. He made 2 comeback attempts but failed. In 1934, the newly formed Securities and Exchange Commission, SEC, made many of his trading techniques harder to use. Wall Street had adopted his strategies, then made them illegal for him. In 1934, he filed for bankruptcy. In 1940, the richest trader who ever lived sat alone in the Sherry Netherland Hotel in Manhattan. He wrote a 12-page suicide note to his wife, saying, "Speech balloon, I am tired of fighting myself." He shot himself in the head with a .32 automatic. His final net worth? Less than $10,000. The man who once held the fate of America in his hands, who predicted financial history again and again, died defeated by the one force he couldn't outtrade, his own mind. Jesse Livermore died alone, but his methods did not. In fact, today's most powerful hedge funds silently operate using principles he pioneered over a century ago. Firms like Renaissance Technologies, Citadel, Bridgewater Associates, and Millennium are all structured around his belief that patterns repeat, human behavior drives markets, and that the greatest risk is entering a trade too early. The tools are different: algorithms, high-frequency trading, artificial intelligence. But the core philosophy? Pure Livermore. He taught the world that money doesn't flow to the fastest. It flows to the most patient. That the crowd is always wrong at turning points. That information is not found in newspapers, but in the quiet shifts in production, liquidity, and sentiment before headlines are printed. His principle, never argue with the market, became the cornerstone of modern trading. His use of stop-loss orders saved traders billions. His method of trend following became the basis of managed futures and CTA strategies. His practice of scaling positions, what he called pyramiding, is now standard in institutional risk models. But here's what Wall Street won't tell you. The same tactics he used to predict the crash of 1929 were used by hedge funds in 2008. In September 2008, weeks before Lehman Brothers collapsed, a handful of funds began quietly shorting retail and financial stocks. Data later showed that these funds had access to insider-like shipping reports, credit default swap pricing, and institutional lending patterns, exactly the kind of alternative intelligence Livermore used in 1929. When the market imploded during the global financial crisis, these silent firms made billions. In Wall Street circles, they were called the modern Livermores. Some insiders even refer to October 2008 as the Second Black Tuesday. Here's what makes Jesse Livermore's story truly terrifying. He didn't just predict the crash, he predicted the cycle. Every boom begins with optimism, then credit expansion, then market participation by the masses, then debt disguised as profit, then inevitable collapse. His trading logs show frightening similarities between the Roaring '20s and today. In 1928, investors bought stocks on 10% margins. In 2007, banks issued subprime mortgages to anyone with a pulse. In 2021, Tech companies reach trillion-dollar valuations without profit. Same story, different actors. Livermore saw this coming a century ago, but perhaps his most honorable contribution was his final warning. Before his death, he wrote a manuscript titled How to Trade in Stocks. Not to teach people how to get rich, but how not to self-destruct. He wrote, "The greatest enemy of a good trader is not the market. It is his own emotion disguised as conviction." He begged traders to follow the trend, respect loss, let profits run, never chase status, and remember that no position is worth losing yourself for. He emphasized that wealth without psychological discipline will eventually become poverty. And here is the most important lesson of all, the one Wall Street doesn't put in textbooks. Backhand index pointing right. Jesse Livermore didn't lose everything because he was wrong. He lost because he stopped following his own rules. The man who wrote, "Never let hope replace strategy," started hoping when the numbers turned against him. He once said, "Mount Everest was climbed not with ropes, but with restraint. When he abandoned restraint, he fell." So what can you learn from the most dangerous trader in American history? Small blue diamond that intelligence without discipline is chaos. Small blue diamond that timing can make a genius look foolish and a fool look like a genius. Small blue diamond that history doesn't repeat, but human behavior does, with frightening precision. Small blue diamond, and that the richest lessons often come from the most painful downfall. Today, Jesse Livermore's private writings sit in archives held by financial historians. His trading methods are examined by billion-dollar funds. Some institutions have even coded his strategies into proprietary AI risk systems. Yet, his name is rarely mentioned publicly. Why? Because power prefers to erase the individuals who expose the system rather than celebrate them. In Wall Street's Hall of Fame, Jesse Livermore isn't framed. He is hidden, but you just brought him back. This isn't just the story of a trader. It's the story of a man who understood the game so deeply that he became the threat. The system couldn't beat him, so it outlasted him. Clapperboard if this shook your understanding of financial history. If you believe Jesse Livermore's story deserves to be heard, then help me share it. Hit that like button, subscribe to Blood and Fortune, and let me know in the comments. Thought balloon, do you think someone with Livermore's power could exist today? Or would the financial world destroy them before they rise? Backhand index pointing down, drop your thoughts, because the discussion starts now. Push bin and stay tuned. What if I told you the next crash may already be in motion, and Jesse Livermore left clues nobody paid attention to?